Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are back with another Ask an Advisor, where we get some of Australia's top advisors in the studio and we put your questions to them. And today we are unpacking two, I reckon, of the hottest topics in the Equity Mates community. Questions we get all the time.
I know.
First up, the big one. Should I invest inside of super or outside of super?
I mean, the amount of times we get this question, the amount of times we answer it, it keeps coming back.
You can't
kill this question.
It's because we're growing. It's because we've constantly got new people joining us on the journey. But then if you thought that was a big topic, this topic is even bigger. Property or shares. We're going to be asking not just which one should we be investing in, but more importantly, how can we invest in both of them together where 1 + 1 can maybe equal 3? So to help us unpack it all, we're joined by Matt Ingram. Matt, welcome back to the show.
Yeah, thanks. So good to be here.
So Matt is my advisor. He's actually Ren's advisor now, and advisor for the stars, we should say.
And he could be your advisor as well.
That's it.
If you head to equitymates.com/advice, fill in the form and ask to speak to Matt, we'll put you in touch.
Yes, Northhaven Financial Management. Matt, we've been working together now for a while, but you are also working with many of the Equity Mates community. So thank you for doing that. I know everyone's that has gone through the process with you speaks very highly. So yes, as Ren said, equitymates.com/advice if you would like to speak to Matt or his team or any of the other advisors that are in our network. The form, we collect a bunch of your details and we'll connect you with the most appropriate advisor for you. So Matt, let's start with superannuation versus personal investment portfolio. I know this is something that you are particularly passionate about. Boring superannuation. But but we want to start general. How do you think about the balance between investing inside of super or investing outside of it?
Yeah. Look, on that note, basically whenever I talk to clients, it's always like we're talking about property and shares and investing and building wealth, and they're all excited. Then I have to kind of say, okay, we have to talk about the boring stuff. And then we get into super and insurance, because actually it is just as important as everything else.
You probably shouldn't frame it as let's talk about the boring stuff.
I'm trying to be relatable. To me, it's actually pretty exciting, pretty interesting. But yeah, most people don't really think of it that way until you actually frame it for what it is, right? So what is super? It's a share portfolio that still belongs to you. You just can't touch it yet. And I have clients all the time who are coming in and they've got $200,000, $300,000, $400,000 in super, and then they've got like a $50,000 ETF portfolio, and they're asking all these questions about the ETF portfolio and what should I do here and what should I do here. I'm thinking, do you not realize that you have almost $500,000 in shares? It's just in super. You just can't touch it yet. How about we talk about that? You know, there's a lot we could be doing with that. So in terms of how do you balance it, going back to your question, it depends on your age, for one. There's not many 20, 30, even 40-year-olds that are coming in and I'm saying, hey, let's go hard on super. Let's max super. There's a lot of things we could be doing to optimize it already. And most people, if you're earning a salary, you know, if you're not self-employed, you're forced to put money in there anyway. So you're already contributing. It's just a case of how can we make sure it's doing the right thing with what you are contributing, as opposed to let's max it out, let's put more in, let's top it up. I'm not really talking about that until maybe sort of mid-40s, all depending on circumstances. Sometimes it's earlier, sometimes it's later. But with balancing it out, yeah, it comes down to age. It comes down to what are your goals. If you're trying to retire early, super's not going to be that helpful until about 60. So if you're going to need another passive income source, you're probably going to want to think about building up a portfolio. Now, whether that's shares or property, we can dive into that later. But it just comes down to so many factors like that.
We get a bunch of questions about this as we sort of flagged earlier. And I think we've kind of grouped a number of them into, I guess, like the investment strategy between the two, or how the interplay between the two. For a lot of people, they are in a similar circumstance to what you mentioned. There's like a decent super balance there and maybe a growing investment portfolio outside of super. How do you think about balancing the two together? And I guess the question that we get often is like, should the super portfolio just be like a retirement version of my existing ETF portfolio?
Not necessarily. So what people are typically doing outside of super is more of that ETF approach, very broad-based, keeping it simple, and that's completely fine. When you're investing in super, you have such a long time horizon. You want to make sure this thing is, optimized. It's going to work hard for you. You've got time to ride out a bit of volatility, so maybe you're willing to take a bit more risk. For example, I'm working with some clients at the moment who, in about 3.5 years, they're going to travel for a year. They're going to pack up, go around Australia. We have a portfolio working specifically for that, and it's a little bit more conservative. There's a higher allocation to some fixed interest and just less risk taking in there, because we don't want to blow up any money before they go away, because that's what they're going to live on for that year or so. But in super, they're high growth, risk on, because they're mid-30s. And so they've got plenty of time before they can actually touch that. So it's not as simple as just replicating one portfolio, but in a different structure. There has to be a different strategy to both, depending on your time horizon. And also, just putting some ETFs in super, it'll probably do well over time. But if you can get access to some other bits and pieces that are going to do even better over time, some good fund managers in there, or different asset classes, then that'll make a huge difference later on in retirement.
Matt's now looking after your super.
Yeah. So
do you have any leverage in that?
I guess my
there is.
I guess my experience has been, I used to use the superhero product, which was self-directed within a confined sort of investment universe. But then when we moved across to you, both myself and my wife, Harriet, have now moved super across to you guys, which gives access through Hub24. And as you said, that opens up a world of opportunity beyond just what is sort of available on some of the retail platforms. Most of the things I'm invested in, though, are that much different to what we could have got elsewhere. But it has re-enthused or re-energized us to actually be a bit more creative, take a bit more risk. To be fair, I was very leveraged when I was in superhero anyway, so I don't know if much has changed there. But the options are great.
Yeah, there's still a bit of leverage, as you know. But also some names that what some of these platforms give you, like wrap platforms, where you can put your super on that as an alternative to an industry fund or just a standard retail fund. They give you access to wholesale managed funds. So typically things where you needed $50,000 or $100,000 to get in. These things let you go in there with $1,000, $2,000, $5,000. And the way they do that is they pull together a bunch of their clients' money and then invest that all together. So you can get access to some really good funds that you couldn't otherwise, funds that have exposure to short positions or just markets that you would never think to invest in by yourself or have access to or know anything about. So you get some exposure to that as well, which helps.
Now, unfortunately for people who don't have an advisor, they can't access those wrap platforms, or generally you can't access wrap platforms without an advisor. There's like a world of self-directed platforms aimed at retail investors that are coming to market, be it a self-directed wrap platform through an advisor or the retail equivalent. How do you think about those as an option for people who want to take more control? Is there any argument that some people should just stick with industry funds and get on with their lives? Like when you're speaking to clients, how do you approach that decision?
Yeah, so you're right. There's quite a few products coming to the market now where you can build out a portfolio in your super. It's typically limited to ASX 300 stocks, or a few ETFs. So you're still limited in what you can get in there. Wrap platforms, you can get basically anything you want. But look, if years of looking at portfolios, more recently doing Pimp My Portfolio, if it's taught me anything, is most people are having a good crack, but aren't quite there. And super is something that is going to be really important one day. It's probably going to be your main income source, one of your largest assets, something you probably want to get right. It's a bit like self-education typically only gets you so far. If something's wrong, you feel sick, you go to Google, you start looking up your symptoms, and you end up 3 hours later like, oh my gosh, I'm dying, I have cancer, like this is terrible. And then you just, at some point you have to go to the doctor, right? And the doctor says, no, it's just this, and gives you some antibiotics and you're okay. You can think of it in the same way with seeing an advisor or any professional. It's just, you can get yourself so far, but a little bit of support at some point, just to iron things out, get things right, can go a long way.
Having said that though, like if you do have the ability to take control within an environment, like let's take Superhero for example, which we'd used, you can buy those all-in-one ETFs. And I remember we did a segment a while back that compared the return of just putting all your money in to an all-growth diversified ETF, VDHG, DHHF, versus these same sort of growth portfolio through a super fund, and it was still better just to go with an all growth ETF. Do you know what I mean? So like, even if you don't know individual stock picking or trying to create a portfolio out of ETFs, like you can still do better with the education around just these ETFs yourself.
Yeah. Look, something like that would probably come out better because it's an all growth ETF. None of the super funds are just chucking you into 100% growth. Even their growth options have,
which is kind of crazy for a 25-year-old. Do you know what I mean? Like it should be.
Yeah. There's always going to be an allocation to some defensive assets in there, and that comes down to just portfolio management. Most super funds or advisors are more focused on a risk-adjusted return rather than just the highest returns, the best return. That's not really the case. A lot of people don't really appreciate that there's a return that is right for you based on your risk profile. You know, the kind of return that's going to not keep you up at night. You could be shooting for 20% per year over year, and just be stressing yourself out and checking it every day. And then there's a downturn and
we'd be fine.
Well, yeah. I mean, this is one world that you're going down, which is like, you should temper the return profile based on people's risk tolerance. The other world, the world that Bryce and I live in, is no, we should go for the mathematically sensible option and educate people around risk, and that volatility isn't risk, and risk is permanent loss of capital, and super is locked up for 40 or 50 years. But, you know, good minds can disagree.
No, I do agree with you in a lot of ways, but like, sure, mathematically, maybe, but emotionally, most people, they're going to take too much risk. And you say you're not going to panic when it happens, but a lot of people will panic when the market turns, and you're freaking out and you're thinking this could go 20% lower. I'll sell now and I'll buy back when it's lower, and you miss it and you've stuffed up and it's gone from there, right? So mathematically, yes. Emotionally, you have to get that portfolio to a point where you know why things are happening. You have some downside protection through exposure to various asset classes. In my opinion. But look, going back to your point, Bryce, with like an all-growth ETF versus an industry fund. Industry funds are a bit tricky anyway with how they report their performance in terms of like there's unlisted assets in there, how often they have to value those things. So when people are trying to compare something that's, where the price is updating in a live sort of manner to an industry super fund where, maybe they've got some property in there or some private equity that hasn't been revalued for 3 months or 6 months. It's just not really a fair comparison. So that's, I guess, another benefit to taking control of your supers. You actually know what it's doing. You know exactly where the returns are coming from. And it's not kind of just I got 8% this last year, but did you actually get 8%, or, what's the real story?
So Matt, if I can just do a bit of a reset here, we wanted to come in and answer the question, should I be investing inside of super or outside of super? And I guess the headline answer is it depends on your goals and your time horizon, noting that super, you have an opportunity to perhaps outperform your outside of super portfolio because of all the tax advantages, but you're not going to be able to access it until you're in your 60s. Whereas, the outside of super, you pay more tax, but you have more liquidity and more access. So you do have to make that personal decision. Is there anything else that we want to give to people as they're making that decision themselves?
No. Like you said, it's just a trade-off between a bunch of different things. And I mean, everyone's going to be investing in their super, whether that's through an industry fund, a wrap platform, even if they're going all the way through with a self-managed super fund and want that full flexibility. I mean, everyone's doing it. I think there's a case for most people, starting to invest outside of super is going to look different because the time horizon's different, the goals are different, the risk tolerance there might be different. But at least getting started, that portfolio outside of super, I mean, all the time I'm having to tell clients that you've come with this portfolio, we might actually need to think about selling that because there's a better use of that elsewhere, or how we structure things could be a lot better. That's going to make a difference longer term. But at least starting with a portfolio outside makes sense, even if you're going to change that up and not keep it forever.
Yep. So Matt, while we're talking about super, we should just touch on the topical topic. That's not what we call it. $3 million super tax. I'm sure clients have been asking you about it. Do you have any? What have you been advising clients?
Well, yeah, look, a lot of my clients are a fair way away from that, although they will likely be affected at some point by it. It's recently been a case of we don't make any massive moves until we know what's actually happening. You know, you don't want to undo a lot of good things to find that actually things change and we didn't need to do that. With some of our more, high net worth clients at Northhaven, they will be impacted as soon as it comes into force there. So with them, it's a case of looking at, okay, what are the consequences of this, and do we get some of this money outside of super? If we do get it outside of super, where do we keep it that is still tax effective? Most of these people are retirees. They have no other assessable income, and so having portfolios in their own name starts to make sense there. But it's the kind of thing, we're not doing anything crazy or wild until it actually happens. And even then, we're not going to do anything crazy or wild, but we'll just set things up.
So for those like Bryce who have an aspiration of having a $3 million super balance, but may not be there yet.
I want it outside of super.
Yeah, well okay. Right, bad example for Bryce. But like,
I've been telling Matt, sell my super.
For people who
Send it to zero.
Okay. For people who are making additional contributions while they're young, like you wouldn't start changing the additional contribution strategy at this point?
I would typically be changing it for a different reason. A lot of clients that are coming who are topping up. If someone's in their mid-30s and they're saying, I'm maxing out the concessional contribution cap, I put in $20,000 a year, but then I top it up with another 10. There's always a conversation of, okay, what could that $10,000 be doing that's going to benefit you a lot sooner than 60? Where could we be putting that to work sooner and still get tax benefits, tax advantages by structuring things correctly? So it's not Div 296 that I'm worried about for those clients. It's other reasons why we're having that conversation.
There you go. Well, hold on. That's the answer to investing inside of super or outside of super that you didn't give us before. It's if you work with you can get the same tax advantage outside of super.
Yeah, maybe not exactly the same, but super is highly tax effective. We all know that, especially once you're 60. The more assets you have in there, once you go into retirement phase and start an account-based pension where everything's tax-free, income, earnings, it's all tax-free up to a limit, that's where you want your assets eventually. But doesn't mean you have to build your assets there. You can, we have plenty of clients who get into their mid-40s, 50s, early 50s. Super's looking, fairly average, but outside of super, they've built a really good base of assets, and it's a case of strategically selling those down and getting them into super so that when they're ready to retire and start a pension, it's all in the right place, but they've had it outside to benefit them earlier.
The other question that we should touch on is just around self-managed super funds. When is the right time to be thinking about that?
Yeah, so self-managed super comes with a lot more flexibility than your typical super fund. A wrap platform, like we were talking about before, is probably somewhere in the middle. So self-managed super fund, you can basically buy anything from shares, property, collectibles, art, probably Pokemon cards. If you don't buy Pokemon cards, but you could probably, you can get anything in there. But it comes with the I don't want to say the burden, but the responsibility of managing the admin, the reporting, the auditing, all the compliance. You're responsible for everything as one of the trustees or a director of a corporate trustee. Now, it doesn't have to be a burden. You can outsource that. A good accountant, a good financial advisor can really take care of a self-managed super fund for you. But if you're at the point where your super is, I don't really like putting a number on it because it comes down to a lot more than that, but traditionally it was, $500,000, then you could start thinking about it. Self-managed super funds are becoming a lot cheaper. That traditional path of having to go to an accountant, spend thousands of dollars to set it up, thousands of dollars per year to maintain it. There's a lot of low-cost offerings now that don't require that. So, I mean, I have clients that $300,000-$400,000, and we're starting to have those conversations about self-managed super, and that could be a combined balance, like, you know, two partners, $400,000. If you can see that's growing, there's a good time horizon. This thing's going to be well over $1 million, $2 million one day. Then getting it set up as a self-managed super fund now could make sense.
Okay. Is it a when? Like Bryce asked the question, like when, as if like it's a dollar amount, or is it like a what? Like a
I want to buy
an investment property.
Yeah.
Well, these low-cost SMSFs, you can't buy property in. So you still need to go down the traditional accountant path to get property in your SMSF. Yeah, it comes down to a lot of it is, you know, what do you like as a person? Are you actually interested in this? Are you engaged in this? If you don't care about your super and you're not engaged at all, then we're not going to put it into a self-managed super fund, because there's just going to be extra costs with, you know, not much benefit for you. But for people who are financially interested and savvy and they want to have some input and control over what their super's doing, then that's when that conversation is taking place. I mean, you might be interested in your super and there's $50,000 in there, not appropriate. But if you're interested in it and it's hitting that $300,000, $400,000, $500,000 mark, then there's definitely a conversation to be had.
But think about the leverage Bryce could get when he gets a 90% investment property. You know, like a for 10% down, 90% borrowed investment property.
Yeah. Well, that's a whole nother conversation whether property should be in super or not. Anyway, a lot of people start self-managed super funds, and we get calls all the time saying, I want a self-managed super fund so I can buy property. I've got this money sitting in there. I've maxed out my borrowing capacity outside of super, but there's like hundreds of thousands in super. I could buy another property with that, you know? And that's where we're chatting about, is super actually the right place for that? It will become quite tax effective one day, but you also have to think of liquidity. I mean, what's super actually designed to do? To give you an income in retirement. And if it's all tied up in property, then there's no liquidity there. You can't just, you know, sell a chimney or whatever it is to get a bit of income if you need it. So yeah, we tend to keep super as a share portfolio, and outside of super is property, where you're getting those tax deductions from the property and you can gear up a little more easily.
Nice. Matt, we've just covered off all the questions around super that keep coming in, but as always, we have plenty around property v stocks, debt recycling, you name it. Let's start again generally though. If you had to pick one, property or stocks?
Look, the boring financial advisor answer is depends on your circumstances. So I'm not gonna do that, even though it's probably the right answer. If I was gonna pick one for most people listening to this, sorry guys, property.
Oh wow!
Because of the leverage? Or?
Because of the leverage. Yeah. Like when you're in your 30s or 40s or 20s, you know, getting that extra capital working for you, it just makes sense.
What about the equivalent leveraged products in stocks?
There's no equivalent.
There's equity builder.
You can't get like a 5% deposit equity builder.
Yeah, the LVRs are higher, but if you had $120,000,
and also, aren't they not taking new clients?
No, that was years ago.
Okay.
I think there is products out there. Interest rates are typically a bit higher. It's a bit harder to get them on interest only. So you're tying up, you're making principal repayments, you're tying up capital in there. Most people, if they're doing an investment property, are looking at interest only loans, keeping, you know, all of that deductibility in the property and then deploying their capital elsewhere. So while you can kind of do it in shares, property, the banks love it. The banks make it easy for you. They're willing to give you millions of dollars to do it.
It's just crazy that we've seen such a boom in private credit. There's so much money in private credit and none of them have got into investment lending.
Oh, no.
And like, if you want to mitigate the risk, make it a 10-year lockup period on the loan. Yeah. So many people
and
would
just
take
do
that
it against
still.
like VDHG.
Yeah. Like
just
super
a
vanilla,
well-diversified, low-cost ETF that over 10 years has always return a net positive.
Yeah, and if anyone out there does that, come on Equity Mates and we'll help you promote it. And Bryce and I'll be your first customers.
Big time.
It just comes down to, I mean, like, even VDHG, thousands of companies, you're probably going to be all right. But at the end of the day, they're companies. They can go bust. A house can't really go bust. And even
that's just the Australian psyche, right?
I know.
There is no 10-year period on the ASX.
Property can go down.
Property can go down, but like if someone's shares drop, they panic and they sell. If someone's home drops, they're like, well, I still need to live.
This investment product would not show the stock price.
No, it's a 10-year. It's a 10-year lockup, so you can't panic and sell. You're locked in for 10 years. You're forced.
If that's the condition, yeah, maybe.
Yeah.
Why not have 30? Just do same as mortgages.
Just super.
Yeah, true. Yeah. But no leverage in super.
All right. Anyway, Matt, we're not here to pitch business ideas to you. We're here to talk about property versus shares.
Yep.
I think people often frame the choice as property versus shares. It's binary. You have to pick a side. But I think what we've learned really from doing this Ask an Advisor episode and segment over the past sort of 18 months is that it's not a choice that you should be making, because property and shares, when working together, can actually produce the better outcome than either of them independently. And the conversation often goes to debt recycling. So let's start there, and then we'll ask you if there's anything else we should be thinking about. So we get a bunch of questions from the community, which goes something like, I'm an owner-occupier. I've started building some equity in my home, started paying down the loan. Prices have risen a little bit. I'm also starting to invest more seriously. When do I start thinking about debt recycling as a strategy? When does it make sense? Or should I just keep focusing on building the offset and paying down the mortgage?
Yeah, that whole property versus share thing, like you are, if you own a property, you're doing both because you have super. That's where everyone just forgets about super, that it is a share portfolio.
We've done the super.
I love super. It's my job. I just love super. But that's just the thing, like you're dollar cost averaging into a share portfolio in your super. So it's never property versus super. You're always doing property versus shares. You're always doing shares. And then you can, focus on property elsewhere. But to come back to that question, if you just, keep saving up cash, paying off the mortgage before you start investing, I mean, with most property prices, you're probably not going to start investing until you're 45, 50 plus. And then you guys talk about compounding all the time. The magic of compounding. You want to start that as early as possible, really. So, and you're getting it to some extent by paying down your mortgage. But if you can get that money that you're putting into your mortgage, if you can get that working for you in another way while still paying down your mortgage, that's where debt recycling becomes really useful. It doesn't have to be one or the other. I think to go back to what you said before, Ren, it's this kind of 1 + 1 = 3, right? You think, I've got some cash. Do I pay down the mortgage or do I invest? It doesn't have to be that simple, right? There's an opportunity cost to both of those. Could be a case of, I've got some cash, I want to invest it, I can pay down the mortgage, I can then use that equity and I can invest. So now you've paid down the mortgage and you're investing, and there's a nice big tax benefit to it.
It all sounds so simple. So I guess in terms of like how much equity people need, because I think that's a question that we often get, like, people buy their property and then they're like, let's debt recycle day one.
Yeah.
Every mortgage repayment.
How would you think about that? Obviously, like, we're kind of speaking generally, so it's hard to be like specifically you need this much, but like maybe there's a percentage of equity you have in the place or something. Is there?
Yeah, typically when you debt recycle, there's two ways to do it. You're either taking the cash that you have, you're paying down part of the loan, and then you're actually totally refinancing and getting a separate loan facility, and that's what you're going to put into a share portfolio or a deposit for a property. Or you can do it maybe a little more simply, where you can split your existing loan, you pay down the split with the cash that you have, and then you redraw it. And so if you're doing $5,000, $10,000 splits, and you keep doing that to your mortgage, you're going to end up with this very messy scenario with a whole bunch of different loan splits. And at some point, banks are going to say, like, what are you doing? We're not going to keep splitting this thing. So I would say $50,000 probably as a minimum, where you've got $50,000 saved up. Maybe now you could think about putting a split in your loan, paying it down, redrawing, and investing it. I mean, $50,000 is a minimum. Maybe $100,000 is starting to look a
That's actually better. That's less than I thought.
But it depends what you're doing. So $50,000 maybe if you just want a bit of a share portfolio working for you. If you're doing this to get into property, So if you think about it, you've got your home, it's non-deductible debt. Now you've saved up a bunch of money in the offset account. You could take that money and go put a deposit on an investment property. But now you've taken that money and you've paid down part of the investment property. That's a deductible asset. The interest is deductible. You actually wanted to take that cash and pay down your non-deductible debt, your home. So you pay that down instead. You then refinance, get access to that equity, and then use that towards the investment property. So now it's 100% borrowed on the investment property, but what you've done is reduced your non-deductible debt and increased your deductible debt. So you've structured it tax effectively.
So
That's why you get paid the big bucks.
Rather than property and shares working
all
together,
back to property.
it's just property and property. It's like, how can we get more property?
But the same thing will apply for shares, right? You could either save up some money in your offset account, go invest that cash, and then you've still kept your non-deductible debt high and you're investing your cash. Why not just take that cash, pay down the non-deductible debt, take it back out as equity, and then use that deductible amount to invest in shares? Your level of debt, your amount of debt hasn't increased. All you've done is change some from being non-deductible to deductible, plus you've got that share portfolio that you wanted.
I guess the difference with the property on property versus property on shares is when you redraw it as deductible debt and then buy shares, then the income from the shares should cover the you can use that to cover some of the mortgage payments. But then if you're doing it property on property, you're getting more leveraged. Most investment properties are negatively geared. So like by definition, you'll have to then come up with incremental cash to cover the difference in the mortgage payments.
Yeah. Big part of the strategy is looking really closely at cash flow.
Like what you can
service. You actually, because you're completely right. If you're going to debt recycle into property, normally, like I just said, you're not taking on any extra debt. Well, if you're doing it into property, you are to get the remaining loan for the new property. So you actually are. So you need to be able to look at, can I service all of this debt? Because you are taking on more. Sure, it's tax deductible, but that's only going to help when you get your tax return. I mean, in that first year, you're out of pocket for sure. And it could be a few $100s a week that you're out of pocket because you've done this. So you need to have the cash flow for it.
Yeah.
Well, we looked at it because we have a bunch of cash sitting in the offset account. But then to your point, when we then looked at the serviceability on the investment property, the banks were like, too bad, so sad.
Yeah, they didn't like it. So normally, most people doing this in their 30s, 40s, where, they are going to be capped in terms of serviceability. You're not looking at you might have a $1.5 million house. A lot of the time it's not going to work to get like another $1.5 million property or something. You're looking at, something smaller, something regional, just something to leverage into the property market and not go crazy with it, basically.
So Matt, we kind of nodded to it, which is leverage in shares. Everyone, I mean, you kind of alluded to it before as well. Like there's that sense that property is just a safer way to use leverage, but it's not necessarily true.
According to Bryce.
According to me, when would you actually recommend using debt against shares, or like what are some of the structures that you use for leveraging into stocks?
Yeah, so if you're going to debt recycle or any sort of leverage into shares, you're probably looking at doing it as a means of diversification. So if someone's already got 3, 4, 5 properties, whatever, then it's getting to the point where you might be thinking, okay, do we really need more property or should we diversify out of this? And at that point, a share portfolio probably starts to make a bit more sense. I mean, I know there's people out there with 100 plus investment properties and, that's fine. That's their strategy and that's what they do. But to get a more diversified approach, shares would come into it at some point. Also, you need to have the ability to service another property. So if you are debt recycling into property, you are taking on more debt. Some people just don't have the ability to do that, in which case they might not be able to borrow more to do the property, but they've still got that equity, like the amount that they just paid down to debt recycle. They can still redraw that and use that. And if that's the best they can do, then let's get it working somewhere, and why not shares?
Love it, Matt. Well, look, I think there's been a lot of, more complex financial structures than we normally speak about here. I guess debt recycling, different uses of leverage, interplay between super and investing outside of super. But I think that's why we appreciate doing this Ask an Advisor segment, because as we learn more about this whole world and I guess how people with means navigate it and optimize it, it becomes clear there's a lot to do and there's a lot to keep learning, and that's why we appreciate you giving us advice both on and off the podcast. So if people want to speak to you or the team at Northhaven, if they go to equitymates.com/advice, put in some details, and we'll either, if you ask to speak to Matt, we'll connect you directly, or we'll match you with an advisor that best suits your needs. But Matt, thanks for joining us. We appreciate you coming on the show.
Yeah, thanks so much.
Thanks, Matt.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.